Hi guys, part two of the essential indicators from FXSSI.com. I want to talk about the ratios and I'm going to talk about the current ratios. So this tells us a snapshot where we are right now. So it's very useful. But the ratios tells us the movement across time. So this is what we'd call dynamic flow across time. It tells us the dumb money flow. Normally what would happen is that if the herd, aka dumb money in speech marks, they're going to go one particular way, you'll find that what will happen is that they're going to be counter trend and they're going to get reversed. So this is the dynamic and this is the static. Okay, so let's talk about the movement across time. This is very easy. It doesn't really need to be a video on it because it's very simple, but this might just require a little bit more deconstruction and information. So what will normally happen is that what will happen is we have like a crossover in the 50%, or FXSSI are saying wait for the grey box, a breakout of the grey box. So that can be okay. You can do the 50% crossover, or you can wait for the breakout of that grey line there. So what normally happen is that they'll go long, and that action there will then push price lower. And it's not a one-off, it happens every single day across multiple instruments. The more liquid the pair is, the more cruel it is. This is the most common currency pair, so this is the one that's going to be exposed the most to the brutal moves that you can see. So if you trade in the EURUSD without the indicators, you could be subject to quite a lot of punishment, and you probably wonder why. Maybe you had this big aggressive move. It's well, they decided to buy up here, and you could probably think, well, okay, so they've gone long, kind of makes sense. They could have probably looked at that and probably thought, well, this could have been a fake out, that looks fake, maybe, and then they start doing this. Actually, it looks quite constructive. Higher highs and higher lows, another higher low, another higher high, another higher high, and they're like, okay, so maybe a good time to buy. Looks fine, and of course, what might happen? They go to bed, or they go to work, and then they do their work, or they wake up, and then in the morning or at their break, they'll look at their screen and like, oh no, this sucks, and then they think, well, I'll hold on, it shouldn't be too bad. Of course, them holding on, it then comes down to punish them. And they're like, well, what should I do now? Sort of desperation area. It looks like it might go higher, but then we had this big wick. This big scary wick, and then that caused them to short. That wouldn't be a coincidence. We see it a lot. We see these price manipulations on the candles, and more often than not, what will happen, if you know what a doji candle is, a doji candle is an indecision candle, so it doesn't tell you any information. It basically, we closed where we opened at that precise moment, at that precise price, and we can see the herd absolutely hate indecision, and that tells us that there's manipulation on the price in order to get them to go one particular way. So it's like a trap, and this would have been a trap. I don't know if you can see that. There we go, zoom in. So this move here, so they're worried, they're wondering what to do and whether or not they need to exit, because don't forget they've gone long up here, and they're thinking, well, maybe I might hold, might exit, I might go long, I'm not sure what to do. And then it does this, and then at that point that would have got them out. That would have probably been the trap candle, because you can see the consequence of them selling. They probably looked at that and think, well, I think it's probably going to be bearish, and then of course some data release comes out or some event, and then it pushes price higher, so it punishes them. And it's really good if you're good at candlestick analysis. You can use them to combine with the SLCs and the ratios. They're really powerful, and it's just basically like a machine that goes up to maximum liquidation extraction, then it makes liquidity extraction, so on and so forth, and up we go. And it's really just important just to get an overview of the how it works, and how to avoid as well being part of that herd as well, because if you could see that them going long, you probably want to avoid joining them. You probably want to be reversing those guys because they're more often than not always, well, 80% of the time wrong. We had a blip here, which is a little bit naughty. So they were saying at FXSSI we should wait for the breakout of the grey box. And if we do it in that situation, that would have been profitable, because if you traded the 50% crossover, it just reversed and it chopped. So if you wait for what they recommend, breakout here, at least that's it's a little bit more risk mitigated. You could get chopped out at the 50% cross. So wait for the breakout, and it might mean that you're a little bit late, but at least you're in a safer place, because you could have got chopped up there. And we're talking about, it's about a 40 pip move, so it wouldn't have been that good. And of course we did that chop, and so that's why we rebounded. Okay, so not a coincidence. It is properly designed to maximally liquidize. All right, so you could argue, oh, these things are moving due to X or Y, but really they're just moving to extract liquidity out of the market. Okay, that's why it's very, very important to get the ratios and the indicators. And time again, we'll see this every single day as well. Let's just go zoom out because we're a bit too zoomed in. All right, and so that's it. I suppose it doesn't really need to be talked about too much. There's that idea of them going trading above the grey zone, which I talked about just now. You know, it proved to be a good place. Albeit you might have been a little bit late, but at least it's a little bit safer, because here we would have got chopped. So wait for that breakout. That's what they're saying. Okay, and you know, you're looking for that confirmation above that grey box, and then you're looking, you know, it's going to punish them, and of course then it's going to punish them, then it's going to punish them. It'll just go on forever and ever and ever. Okay, and you know, they decided to go long here. This is the Aussie, and you know, we're actually technically quite bearish, because you can see we're making this down channel, strong down channel, another down channel, but yet they held. You can see them going sideways, and they just held. They held long up here. They went long and they held all that time. And now what happened is, because they've got finite funds, which I said in the very beginning video, is that they can afford to push price sideways or go up or down, but we can't afford that because we've only got finite funds. So what will happen is that we'll get to a point of exhaustion and extreme, and then we'll see price reversal. Now what would happen, you may find on some indices and gold and crypto, is that the herd, they had terrible risk management. Some of them weren't using stops, and that's why we propelled higher and higher and higher on those instruments, because it was seeking liquidity. And if they're not using stop losses, it's going to continue high until they've got margin called. All right, so that's the reason for some things that just keep pumping and pumping and pumping. You may have seen yen this year, and the Bank of Japan had to intervene. The retail guys were so, they were using a hodl mentality without stops, and they were getting margin called and accounts getting blown up. And it wasn't just retail, hedge funds as well. They got blown up this year on their yen exposure. So that's what a brutal environment that we're in right now. So you've got to be careful, and you must know your exit as well. And the SLC video is useful about exits as well, because that tells you where to place your stop losses. But this is a video for the ratios, and you can see how it works. And if they're not using stops, then they're going to get liquidated. And that explains why it's doing its price discovery, and it'll keep going and going and going until they get liquidated. And obviously there's the correlation there, which you would see every single day. If you just get the indicators, then you'll see. Right? So it's fairly straightforward what happens. The reason for it is that they're going to get squished, and they're going to get punished, and they're going to get stopped out, and then it's easy money. And then you could also argue they wanted Aussie Euro USD down for fundamental reasons. And it just happily coincided with their trades. You know, when I say they, I'm saying the banks and the institutions. Perhaps they wanted to sell the USD, and it just gave a really good reason to sell it, because the herd were long. So they're going to push price down because they think it should come down anyway, and it's going to liquidize the retail, and it's going to take their stops. And it's going to be mega cruel for the retail guys, but really beneficial for the big fish. Okay, so, you know, try not to fight the sentiment. And that's it, I suppose. this does need addressing, which I can talk to the FXSSI guys about. But what's happened is that the IG group and Oanda have been removed, or at least I'm sure that Oanda have. I think IG have as well. But it's just to say that there's a formula for the average value, but that will need to change now. That needs to change. So it's just a case of the website owner just changing that. It's not like a big deal. But you can see how it aggregates multiple brokers, which is really cool. And that's it. So don't forget, this is the flow of time. So we'll talk about the snapshot data now. And it's very easy. So come to the sentiment. We won't talk about the free indicators. We'll just talk about the sentiment ones. And don't forget, these require a license. They're not free. Okay. And current ratio. So it's dead simple. Basically, in a nutshell, if they're long, it's going to be a sell. So we'll have a red light. If they're short, it's going to be a green. Perhaps a little caveat here. If you're using these indicators, this current ratio, if you're getting red and greens, and there's a lot of indecision and there's some grey, just avoid it, come back tomorrow or change the currency pair. Now you'll see it takes up a lot of the screen. You can minimize that by just clicking on that screen, and it minimizes, and it tells us the average in a condensed way. So it doesn't require you to have the whole thing up on your screen. You can minimize it, and it has the information there, the pertinent information that is required is there. Right, so it's dead simple. And like I say, it's a snapshot. So this is where we are in time. The ratios tell us the flow of time. And so really, I guess it doesn't need to be much talked about this, because it's quite common sense. You know, if they're very short, you know, you're looking to buy, because what's going to happen, they're going to get squeezed and then they're going to get stopped out. Right? And likewise, if they're very long, we're looking to sell. Perhaps a little things that you've got to be careful when they're too extreme, because we'll see reversals. And don't forget, they've only got finite funds. If they exit en masse, then we're going to see a reaction in price. So a less short or less long, and that's going to reflect in the sentiment. Because if they're selling something and they become less short, it's going to change. If they're long and then they're going to be stopped out, they're going to be less long. And then that's going to reflect in the sentiment as well. So it's very much going up to liquidate, and it's coming down to liquidate, and it's price discovery, and it's just coming up to squish, and it's coming down to squish. And this should keep you on the right side, because you want to be trading on that 50%, and then you know that you're at least on the right side, and then you're looking to trade it that way. And so that's it. Very simple. And you probably don't really want to change this. It's up to you. And that's it. Very simple. The snapshot, the current ratio. The ratios are slightly more complex, but it's really quite simple. It's a case of just watching what they do and try not to join them, and try and reverse them if possible. And that's it.